warm welcome to this MCA webinar today with Equitech, our associate members. My name is Alan Lehman. I'm the Chief Executive of the MCA, and I'm delighted to welcome you all here today. Equitech are going to present on their findings of their annual survey that they conduct of how buyers of consulting firms will be spending their M&A budgets in 2017. And I know that a lot of people will be interested in what they've discovered. Our two presenters today are Alex White, who is Head of M&A and Strategic Advisory in Europe for Equitech, and Ramon Param, who is Equitech's Buyer Coverage and Market Intelligence Associate, and he is based in New York. They're going to present for around about 45 minutes or so, and then there will be some opportunity for questions. You can post your questions. Please do so whilst they're speaking or when we get to that point using the control panel on the right of your screen on this webinar. Your question box appears towards the bottom. So please do take advantage of that. Enjoy the webinar. Thank you very much for attending, and over to you, Alex and Ramon.
Thank you very much, Alan. And Ramon, if you could scroll down. So, yeah, thank you very much for that introduction, Alan. My name is Alex White. I'm Managing Director and Head of M&A and Strategic Advisory for Equitech in Europe. And I'm joined by Ramon, who has a background working at Macquarie Group's corporate finance business, and interestingly also was a key member of PwC's global corporate development team, and indeed advised PwC when they were making acquisitions of consulting businesses. The agenda that we're working to today essentially is an introduction to the research and survey that we've carried out, and the M&A activity expectations and demands from strategic global buyers. And Ramon, if you could scroll down. Their propensity for acquisitions and the sectors that are particularly in demand and the region, before moving on to looking at how buyers are telling us that they're evaluating acquisition opportunities and their perspectives at the moment on valuation and deal structuring, before we wrap up after about 40 minutes or so for some Q&A. If I may just now briefly introduce Equitech. Equitech was founded in 2004 by management consultants who had successfully scaled their own consulting business to around 350 people before selling that business to private equity. Taking what they'd learned about scaling a business to create equity value, to be able to realize it, they advise other consulting firms on their own growth to exit journey. If we fast forward to 2016, Equitech remains very focused on strategic advisory, so operating and financial consulting services to create and maximize equity value, and corporate finance, arranging global sale processes. Equitech are specialists in knowledge-rich, often people-dependent consulting businesses, and the team here have been clients and know what it's like to be on the other side of the table. The kinds of organisations that we often deal with on behalf of our clients who are looking to engage in M&A are sort of illustrated here. So I guess the insights that Equitech bring and also reflected from the buyer survey are the strategic priorities of some of the very large consulting businesses globally. If we forward wind, coming back to, I mentioned that the original founders' approach for Equitech was to work with businesses to grow value and scale in a way that made them sellable. Consulting businesses are particularly risky acquisitions for buyers because of their people dependency. And a lot of the work that we do and a lot of the insights and perspectives are all around how to de-risk a company and how to grow value as a result. And as we'll touch on here, some of the issues that buyers are particularly concerned about are obviously important ones to bear in mind as developing, while developing your business. If we move on to just give some more context, here are just some examples of some transactions we've been involved in recently, and some of those names may be familiar, but ultimately these are all people-dependent businesses and dealing with the sorts of concerns that buyers have when engaging in M&A in this area, and also dealing with, in many cases, helping to develop these businesses prior to a sale. So it's in that context and in that background that we're delighted to bring to you the insights from our annual M&A survey. And I'll hand over to Ramon now to sort of introduce the approach that we took this year. Thank you.
Thanks, Alex. So this year's survey consisted of a study we asked an independent third party to undertake over summer of 150 buyers around the world. This included strategic buyers within each of our 5 consulting segments, so management consulting, IT consulting, media, engineering consulting, and HR. And for the first time, the perspectives of private equity that invest in the industry. So as mentioned by Alex, the report's designed to distill the large amounts of exclusive data that we gathered from this survey to provide you with insight into buyers' appetite for acquisitions, their demands, their approach to evaluating opportunities, and how they price and structure transactions. So with that, let's dive in and take a look at what we learned about buyers' demand for deals over the next year. So firstly, on this slide, we asked buyers what the balance was between inorganic and organic growth as part of their overall business strategy. 87% of all buyers that we surveyed told us that they consider M&A to be a key driver of their growth. The results for management consultants specifically were broadly in line with this overall survey result across segments. For engineering consulting buyers, the results stood out as they had a higher propensity to do deals, with 74% of them expecting acquisitions to be a key driver for their expansion. The strong results in this group appears to be driven by the recovery of a broader engineering industry this year, which is benefiting from more stable oil prices and strong macroeconomic fundamentals supporting infrastructure spend. So, flipping to the next slide, we also asked buyers how many acquisitions they're looking to make over the next 2 to 3 years. As you can see, across the board, buyers that we surveyed are acquisitive, on average expecting to make almost 4 acquisitions over that 2 to 3 year period. The overall result is again broadly in line with the findings for traditional management consultants, who are expecting to make 3.6 acquisitions over that same time period. For media buyers, however, the results stand out. They're expecting to do on average 5 deals, and 8% of these respondents told us that they'll make over 10. We expected the results for this buyer group to be particularly robust. Digital disruption to business models, particularly as it relates to customer experience, continues to drive demand for new cutting-edge digital media capabilities amongst clients, which is translating into demand amongst buyers to build on this capability. Now, on this slide, we consider the relative volume of acquisition opportunities that buyers are seeing in the market. So around 31% are seeing more opportunities than last year, and 25% are seeing less opportunities than last year. The dynamic is a bit different for traditional management consulting buyers, where 24% are seeing more opportunities than last year, but a slightly higher proportion are seeing less opportunities than last year, indicating that the number of new opportunities coming to market may be starting to fall in this segment. In contrast, almost half of engineering buyers said that they were seeing more opportunities than last year. Again, possibly a reflection of some of those strong market drivers that we discussed earlier. In contrast, HR consulting buyers placed lower emphasis on M&A as part of their growth strategy. And across the survey this year, our results suggested that this segment was a slower market for M&A activity in 2017. It may be more reflective of demand for lower margin staffing companies as compared with higher value HR consulting propositions, which in practice we typically observe strong demand for. Now, moving on to the next page, we summarize some of the information from the latter slides and also present some data on optimum size of acquisition and average budget across buyers for M&A in 2017. With respect to budget size, IT consulting buyers have much larger budgets than other consulting groups, which along with some of the other strong acquisition trends for this buyer group reflects a highly active segment of the market for deal activity expected in 2017. We expect demand to be focused on expertise relating to the latest cloud applications, which we're continuing to observe have a disruptive impact on the broader technology industry. Now, across the board, we also typically find that those listed strategic buyers across industries that are focused on EBITDA performance are looking to make earnings accretive acquisitions and are therefore typically willing to pay up to their own publicly traded EBITDA valuation metrics. So in the current strong equity market conditions that we're experiencing, this dynamic creates a potential for full valuations for the right opportunity from this listed buyer community. So, big picture, deal activity for 2017 is expected to be strong overall. There's robust demand for buying businesses and significant capital available to do deals. Although the proportion of buyers seeing more opportunities than last year is higher than the proportion that are seeing less, this latter proportion has increased significantly from 8% to 25%. So what does this mean? Identifying those buyers that are acquisitive but have potentially been more selective on their acquisitions over the last year, possibly resulting in them seeing less opportunities than last year, and then positioning your company with these buyers in a carefully managed process may enable you to achieve a premium valuation for your consulting business. So we've looked at demand for acquisitions. Let's move on and consider what capabilities and areas of expertise buyers told us they want to acquire. Now, as mentioned in the introduction, for the first time this year, we included private equity into our survey. When we asked these buyers what specific areas of consulting expertise they're looking to acquire, they ranked management consulting, IT consulting, and media as being particularly important. Now, private equity are typically generalists with a broad interest across business services. So even though they highlighted these areas as being important, we would expect them to demonstrate interest across various capabilities, looking at opportunities with strong management teams and robust investment characteristics, which we will discuss a bit further later in the presentation. When we consider the responses of strategic buyers, our research suggests that most of them prioritize expanding their existing core capabilities first, but also at the same time demonstrate an interest in acquiring complementary capabilities in adjacent segments. So what are the ramifications of this? The importance of this convergence trend is that it creates the potential to achieve a premium value for a consulting business if it's carefully positioned and the synergy potential of that business is carefully positioned with those strategic buyers in other adjacent industries. So digging into this trend a bit further on the next slide, let's look at what the specific convergence trends that we observed from our survey. So there were 3 evident findings. Firstly, traditional management consultants, media and IT consulting buyers all demonstrated interest in each other's segments. We continue to observe and practice from organic growth and M&A investments of regular buyers of consulting firms like Accenture, Deloitte, IBM, who are developing innovative customer-focused consulting services which connect marketing, business advisory, and technology consulting as being evident by this trend that we observed from our survey. Secondly, we also observed engineering and IT consulting buyers that we surveyed having a converging acquisition demand. Our dialogue with buyers in both of these industries suggests this may reflect the opportunity from new trends impacting consulting clients in the engineering industry, like building information modeling, digital transport, and the use of advanced data analytics solutions to improve efficiencies and cut costs. We also observed HR buyers increasingly moving up the value chain to acquire traditional management consulting capabilities. Many HR buyers, and for that matter, buyers in other industries that we are regularly in dialogue with, typically view a traditional management consulting engagement as a precursor to their own offering, which often creates a perception that a strong management consultancy can be a tip-of-the-spear acquisition to allow these buyers to enter new markets. Now, moving on to the next slide, in addition to specific horizontal service lines, many buyers are also interested in acquiring capabilities within underlying client sector verticals. So this year we asked buyers what sector expertise is important to them. As you can see, most buyers prioritize consulting businesses that are diversified across sector, but also demonstrated interest in specific sector focuses. Engineering buyers, as we would expect, heavily focused on the energy sector. Traditional management consultants, IT and media buyers, all were interested in opportunities focused on financial services. An industry many buyers are telling us that they see plenty of long-term opportunity from advising clients on trends like digital disruption to banking, regulatory change, and cybersecurity concerns specific to the banking and finance industry. Private equity also have a strong interest in financial services, but also ranked healthcare as being a sector of importance. A sector that is attractively defensive in nature for this buyer group, and its growth is also underpinned by changing demographic trends. Now, finally on the next page, we also asked survey respondents that had a global responsibility at their buyer what specific regions they prioritized for M&A investments. So the majority of buyers highlighted North America or Europe, Middle East as their priority for acquisition. We would expect this given most buyers are already established in these regions, and they typically offer more mature consulting opportunities. Now, of both of these regions, those buyers focused on North America had far higher M&A expectations. So this is where our survey suggests most of the deals will continue to happen over the next year. Now, acquisition appetite was lower in the Asia Pacific. However, in practice, we typically observe that M&A markets for consulting within this region vary considerably. Japanese buyers are highly active, and more mature markets within the region like Australia and Singapore are buoyant. Lots of activity is occurring there. Private equity, they were focused on investing in developed economies as well, but also demonstrated a stronger interest in emerging markets as compared with strategics. possibly reflecting a stronger risk appetite and demand for higher growth opportunities. So that covers our review of buyer demand and M&A trends. I'll hand over to Alex to discuss our findings with respect to how buyers are evaluating pricing and structuring deals. Hi, Alex. I'm not sure if the recording's gone over to you.
Hello, can everyone hear me now?
Hi, Alex. I can hear you okay now.
Fantastic. So apologies for that, everybody. The next section of the presentation here looks at how buyers are evaluating acquisitions and their approach to valuation and deal structuring and what's important to them when looking at a new opportunity. So if we move to the first slide, we asked the large global strategic buyers what sort of level of minimum acceptable key performance indicator that they would expect to see for them to want to progress with an acquisition. This sort of data set is quite useful as context because clearly in terms of positioning a company for sale, ideally you want to go to market knowing that buyers will consider the KPIs attractive and that there will be sort of approval to proceed. So we asked what revenue growth expectations buyers had, gross margins, revenues per employee, and utilization rates. Now naturally these are averages, and different buyers and different sectors have different contexts and different perspectives. So underlying this is a wealth of other data, of course, but this provides a snapshot. Revenue growth, generally, we go back up please. So generally speaking, revenue growth of around 10% was considered to be a general minimum expectation. It's interesting here to see private equity setting out a stall demanding perhaps higher growth for their interest. Around gross margins, again, typically the lowest levels of gross margins of 40 to 50% were expressed by most buyers, and again we see private equity being a higher there. In terms of revenues per employees and thousands of dollars, again private equity suggesting a higher bar for their potential interest, but otherwise a pretty typical grouping around $250,000 to $300,000 per employee as being a typical minimum level of KPI. And around utilization rates, again, that is sort of mid-60s to 70% being pretty typical. Of course, that utilization rate varies depending on what level of staff, whether junior staff or senior staff, you'd expect more differences. Of course, a set of averages belies a set of averages. Could somebody, Ramon, could you mute? Thank you. Utilization is important because it reflects, in a sense, the efficiency of a business, but it can also be indicative of its ability to grow. If utilization rates are particularly high, that suggests that the ability to continue growing at the same rate could be under some pressure. Similarly, utilization rates could be low because a business has invested and taken on more staff, and that could actually support a story that suggests a high growth case. So averages always have to be treated with a degree of care, but we are broadly speaking seeing buyers across the different segments taking a similar approach, but in each case with private equity setting the bar higher than corporate buyers. If we can move on, Ramon. So in addition to some of those financial metrics, we also ask buyers their perspectives on some of the qualitative metrics, such as the size and quality of client base, intellectual property, management team, and so on. And we draw some contrasts here to our survey last year. The same key issues were important, in particular the client base. Client base obviously is key to a buyer because ultimately they're looking for opportunities for synergy value. And that synergy may come in the form of cross-selling services. And the key aspect there is for a buyer will be the ability through a new partnership and through an acquisition to access a company's client base. Of course, here we come into some of the issues around people businesses. It's important to be able to show a buyer that the relationships with clients are spread within an organization and are not dependent on key people who might be at risk from the buyer's perspective of leaving the business. And so that focus around client base, relationships, how they're managed, and the ability to sustain those relationships going forward is one of the single most important areas of M&A for a buyer. Coming up very close behind is intellectual property. So ultimately, intellectual property, the ability to demonstrate intellectual property either around methodologies or around services to clients is a way of demonstrating that a business is sustainable. Now, intellectual property can clearly take many forms, both the registrable forms, such as software, but also in ways of working and ways of communicating with the market. So we digged in a little bit more about perspectives on intellectual property, and the graph below sort of clearly shows that software and methodology is deemed to be very important. Private equity in particular put more store by software and methodology than they did by other areas. And in particular, there were aspects such as benchmarking and market data that perhaps they put less store by compared to strategic acquirers. And I think this is indicative of the point Ramon made earlier, that most private equity investors are generalists and often need a high degree of educating about a consulting business and its proposition, and a way of understanding intellectual property that is different perhaps to the classic registrable kind, and taking care to really articulate and explain why a business is sustainable, I think is a key part of appealing to any private equity investor. Moving on. The next part of the survey with buyers was we asked their perspectives on valuation. Clearly, this is an interesting and important area, and I would stress here that at the end of the day, we're asking buyers what their view is of value. So we wouldn't expect them necessarily to push the boat out. We'd probably expect them to be a little bit cautious in how they respond to this kind of question. But big picture, we asked what their view was, what they would pay, assuming a consulting business with a 20% EBITDA margin that's growing, it's a healthy business growing at 10 to 20% per annum. Now, as an average, the buyers that we surveyed said, well, 54% of them said that they would be paying less than 7 times current year adjusted EBITDA. Within management consulting itself, that rises to 64%, would typically pay less than 7 times. this is an important stat because it's a sort of reflection, I guess, that owners about what they're up against in the market. This is what buyers would like to pay, and clearly an owner is interested in trying to achieve a higher valuation than this. And we saw earlier from Ramon's slide that an optimum sized acquisition for some of the consulting businesses we spoke to was around that $30 to $40 million mark. So these aren't necessarily small firms. These will be 5 million, 6 million EBITDA businesses. But what buyers are saying is they would like to, most of them would like to pay less than 7 times earnings. So it's against that context that really planning a sale process and positioning to appeal to a strategic buyer is very important in trying to achieve some of those higher multiples. If the other thing that's worth just sort of drawing out here is that we're talking about adjusted current year EBITDA margins and not historic last year profits. The first thing to say about adjusted EBITDA is that most businesses, especially owner-managed businesses, have expenditure and items which aren't reoccurring, and there's invariably a degree of adjustment to reflect the true underlying profitability. So that when we read about multiples from other transactions that are reported, quite often they come out slightly higher. That's because they're being calculated using unadjusted EBITDA multiples and usually historic multiples. So that's part of an explanation about why we're seeing some slightly lower numbers here compared to some deal multiples that one might see reported in the press. Moving on to the next slide. This asks the same groups of buyers for a similar type of business what pricing they would expect to pay if profits were growing at a much faster 30 to 40% per annum. So very high growth here. And in general terms, buyers are saying that they would be prepared to pay 30% more for businesses that can demonstrate high growth and an ability to sustain that. So whereas we saw for management consulting that 60% wanted to pay less than 7 times last time, but for a 10 to 20% growth business, in fact, flipping it around with high growth, 44% would actually pay more than 8 times for a high growth business. I think this really reflects back now the importance and premium from being able to show to buyers both a trajectory that's positive, but also an ability to sustain that growth. Ultimately, all underpinned by market proposition, intellectual property, and an operating model that a buyer can absorb into their business. If we move to the next slide, this just brings together a summary, really, of what buyers' perspectives were at different levels of growth. And we can see there, of course, paying higher multiples, the higher the growth levels are. The other thing that that was really drawn out here is media consulting businesses we saw earlier had the highest acquisition demands of the buyers that we surveyed. And that seems to be reflected in their willingness to pay higher prices at the moment. And again, with private equity, the pricing that they're prepared to pay exceeds all of the levels that the corporate strategic buyers suggested they were prepared to pay. Although we also saw that PE set the bar higher in terms of some of the minimum KPIs that they wanted to see. Ramon touched on earlier that we're seeing, or increasingly seeing, acquisitions across different verticals, with media buyers wanting to acquire consulting businesses and IT businesses and so on. And this sort of convergence in the market. When considering a sale of a business, really understanding what buyers want and where the buyer universe may come from is pretty key. So as we're seeing at the moment, with media and IT consulting businesses generally being prepared to pay more, it's very much worth giving a lot of thought to who the right buyers to speak to are, and some of them may be less obvious than what might first appear. And a well thought through buyer list is clearly key here to trying to secure the maximum value. We'll come back to private equity in a bit, but there's no doubt that any growth business who's looking to, where owners are looking to realize value, should always very seriously consider private equity as part of any process. Why are private equity paying higher prices? As we can see here, this graph correlates the revenue growth that buyers are expecting with EBITDA multiples that they're prepared to pay as an average across those three ranges we saw earlier. The size of the circle here represents the number of investments or acquisitions they would expect to make over the next couple of years. So the larger the circle, the more acquisitive. And there's a pretty strong correlation, but stand out again here is private equity. And so why are private equity prepared on balance to pay higher prices? They don't necessarily have the ability to, there's no strategic value in a sense. They don't have any clients, there's no cross-selling to do, there's no strategic premium reflected into it, but they are prepared to pay higher prices. And ultimately that's down to the private equity model. The private equity model is typically they have a fund for 10 years and they have 5 years to get the money out and another 5 years to get it back in simple terms. And they're hardwired to invest. They need to make investments in order to have a stock of portfolio companies to sell in the future. And again, coming back to this point about a well-selected buyer list, careful thought around private equity with an interest in consulting businesses, and perhaps at a stage of their funds where they need to invest capital, perhaps because they're running a little bit behind their run rate of investment, can really make quite a difference to the price that can be achieved. So moving on. Moving on from price to deal structure, we ask buyers what proportion of deals involve an earn-out within their sectors, and there's no doubt that the very vast majority of transactions in the consulting sector include an earn-out. The vast majority indeed, and ultimately this is a reflection of risk and a buyer's perception that consulting businesses are dependent on their key people, and that an earn-out is the best way of reducing that risk, so that if people leave, that business is less likely to grow, and therefore the price that they will pay overall will be lower if that happens. So earn-outs are key, and therefore for owners of businesses, this is an important area to consider, because the final exit, if you like, in terms of realizing full value, doesn't necessarily happen on the day the sale and purchase agreement is signed, but actually happens over the next few years as well. If we move on, we ask buyers what kind of period they would typically expect to structure their earn-out for. If we take management consulting, the majority, it's around 2 years, or say 2 to 3 years. Very few buyers that we spoke to would structure an earn-out for less than a year. And I think generally speaking, they would always try to get an earn-out period for as long as they felt they could get away with. For some businesses, a longer earn-out period could potentially make more sense if there is an ability to share in some of the synergy value that could be obtained from joining with a larger buyer. For others, clearly cash now or cash sooner is a better outcome. But again, the positioning of the business and trying to show why an acquisition is less risky is very important to getting the quality of deal structure and hopefully a lower earn-out in any sale process. If we move on to the next one. So we asked the buyers what's their target deal structure, and broadly speaking, around 45% said they would pay 45% of the value up front, and then somewhere between 15 and 20% would be deferred but fixed in value and not contingent, and around about 35 to 40% as a deferred earn-out, so contingent on future performance. This is very important data for owners, because this again reflects what what companies are up against. Buyers don't want to pay full value on day one. So the objective of any process has to be to show buyers why it's okay to pay more. In our experience, the degree of value paid up front varies considerably from what the survey suggests. This graph just shows here a set of our recent transactions that Equitech were involved in both in helping clients prepare for a sale process and then arranging that sale process. And it showed that certainly the vast majority of our clients achieve a better result than buyers are suggesting they would typically target. What underlies that, of course, is preparation and demonstrating to a buyer why their acquisition is less risky. Thanks, Rowan. So, in summary, just sort of moving to conclusions, we've clearly had the message back from global strategic buyers that there's robust demand for further acquisitions. More than that, large buyers fundamentally depend on those acquisitions for them to sustain their growth. It's not really a choice. They have to continue making acquisitions. It's actually part of their business to have a rolling acquisition plan. We've also seen a growing convergence with sectors being interested in making acquisitions outside of their own core area, in particular around management consulting, media and IT, and from engineering consulting businesses acquiring IT as well. So this convergence trend is important in understanding who the potential buyer universe is and who might be prepared to pay most for a particular business. We also saw that there was, compared to last year, there were more buyers that were seeing fewer new opportunities, and that in this case a sort of good understanding of what level of M&A activity an individual buyer has been going through in recent times could provide some indication of their need to make an acquisition and perhaps extracting some kind of scarcity premium. So overall, though, buyers are holding course, and I think this is interesting because this survey was carried out at a time of Brexit, post-Brexit. It was carried out at a time of the US general election was in full flow, and what a Trump presidency may entail. And there are lots of pretty major geopolitical events going on. And I think the key point is that strategic buyers seem to be telling us that they're taking that in their stride, and they're maintaining their M&A momentum, notwithstanding those big events. I think finally the other key message here from the survey was that buyers don't want to pay. Buyers will always target paying less upfront and a lower value than perhaps owners would like to achieve, because what they're fundamentally doing is, whilst they have to fuel their own growth, they do need to mitigate and reduce the risk of acquiring people-dependent businesses. And I think this points to the importance of developing an equity transformation plan that's both about growth, but it's also about reducing the risk from the perspective of a buyer. Putting in place actions over time prior to starting a transaction process, absolutely no doubt that will help maximize value and increase the chance of a success at better than average multiples. So that transforming equity value is something that can't necessarily be put in place in 6 months or so, but some real planning several years ahead of a planned process is a key part of the thinking of about how business should maximize value. Equitech has on its website Equitech Edge, which on the next slide, which is a free online source of information and advice for consulting businesses who are considering a future sale of the business. There's a lot of content there, and I'd encourage you to have a look because it picks up on some of the themes that we've explored here, and actually how to address some of those buyer concerns in order to make a future exit highly successful. That concludes our presentation today, and thank you very much for listening. And we're open now to some Q&A. Thank you very much.
Alex and Ramon, it's Alan Lehman here again. Thank you both very much for what I thought was an exemplarily clear and concise presentation of your report. I can answer one of the questions that somebody's asked already, in that I can tell everybody on the call or on the webinar that a recording of the webinar, plus indeed a copy of the report, is going to be emailed to everybody by Equitech in the next 24 hours or so. So you will get copies of all this material. So perhaps everybody can stop taking detailed notes at this point. So thank you very much again to both of you. While people think of other questions and perhaps type them in, perhaps I could begin and take advantage of the fact that I'm chairing this. And I don't know who will want to answer this, but I was interested in one of the big themes that came out of the report was really about convergence, the amount of interest there is between the different sectors that you've identified, whether it's engineering, media, management consulting, IT, and so on. And I was just wondering, from your experience, how you go about, because a lot of those connections will not be, I guess, intuitive or well understood in each sector, how you go about testing whether there will be an interest. Say, you mentioned media and marketing expect to be very active in mergers and acquisitions, whether they would, for instance, be interested in a management consulting business as an extension of what they do.
I'll take this one. So I think it's a good question. So when we think broadly about strategic acquirers potentially being interested in businesses operating within different industries, we typically think of that in terms of the synergy potential for the buyer. So in this question of a media buyer potentially be looking at a management consulting capability, the angle we would consider is typically focused on whether the media buyer can use that traditional management consulting capability to develop a synergy. So here it would be probably using the management consulting capability to develop business strategies for the media buyer's clients to deal with broader disruptions that are occurring in their industry, which would typically be synergistic with the media buyer's existing media capabilities. As we touched on earlier, a lot of the disruption to many industries is now heavily focused on digital transformation, particularly as it relates to how companies interact with their customers. Now, we focused on our webinar on 3 convergence trends, including this one. But as Alex and I mentioned, there's obviously many more shifts occurring in service offerings across many regular buyers. So it's really important to understand these trends relevant to your buyer universe as you're preparing your buyer list. And then it's important to be able to properly articulate that synergistic value to that potential acquirer that is operating in an adjacent industry, of adding your capability to their business as you're positioning your company with them during a sale process.
Thanks very much. That's very, very helpful. Another question, if I may, from this end. And Alex, you spoke very confidently about how buyers were taking not just Brexit, but the election of a new president in the US and other global events. I think your words were in their stride. Now, perhaps it's worth saying that Brexit hasn't actually happened yet. We haven't even begun the negotiations, and President Trump, of course, has yet to take office. He'll only do so in January. How confident are you that that will continue to be the case in 2017?
Yeah. Thanks, Alan. I mean, ultimately, it's always very difficult to look further than sort of 12 months ahead at any point in time. But unquestionably, what we've had, both through survey but also anecdotally in all of our discussions with strategic buyers, is two things really. The first is that they depend on acquisitions for growth, particularly listed companies. It's far easier to acquire capability than it is to invest in a new capability. It's just the way, I guess, quoted markets work. Acquiring a company, acquiring earnings, protects the earnings per share KPI, and therefore there's always generally a preference to acquiring than investing for that reason. I think secondly, there are so many macro issues in process at the moment, particularly around, as Ramon mentioned, digital disruption, that it's important for the large consulting buyers to be acquiring in the best talent and the best innovation and new ways to keep their machine on the road. I think thirdly, whilst there's been some commentary on what Brexit might mean, for example, to the UK economy, none of that's actually happened, and there is ultimately, you know, a view that says, well, there's a lot of hype around this potentially, and actually we shouldn't be waylaid by something which hasn't yet come home to roost in terms of sort of economic prospects, for example. So whilst you can never be sure what might happen, you know, in the future, for the moment buyers are really clear it's not affecting their appetite to make acquisitions in the UK. I think if you were a more cautious owner of a consulting business, you might consider whether there's any benefit in taking advantage of the current sentiment as opposed to what that sentiment might do in a couple of years' time. I suppose we have had conversations with owners, you know, along those lines. But all we can go by at the moment is for the next 12 months or so, buyers are pretty clear. It's not affecting their appetite or their intention to do deals.
Very interesting. Thanks very much. A final round of questions, if I may, and this would be about private equity. One of the very interesting themes that you picked up in your presentation, private equity buyers both set a higher bar of what they want to see in their acquisition, in the companies they acquire, but also are perhaps prepared to pay higher prices. We've had a question in which says, once they've acquired a management consulting firm, how are they likely to behave when they're in control? Do they have a benign attitude towards their new asset, or do they like to get deeply embedded and take control of how it's run? And perhaps related to that, if you could also give us some thoughts about if firms are interested in being acquired by a private equity buyer, looking to sell into that sector, what's the best way to go about the positioning of your firm to appeal most directly to private equity?
Sure. Thanks, Alan. So how do private equity behave post-deal? Well, ultimately, private equity investors' job is to invest capital and then in, say, 3 to 5 years' time, get that capital back and make a profit. And that's actually the two things that they're really concerned about at the end of the day. If private equity spends too much time interfering with a business or trying to run a business or manage a business, then what's happening there is that's taking their time away from their fundamental aim, which is to invest to create a portfolio of companies they can sell in the future. So private equity don't want to interfere too much. They don't want to do management, and they don't want to take management's job away and do it themselves because they can't. they're fundamentally interested in backing great management teams in great businesses. And they'll be far more successful in just sticking to their knitting than it will be to sort of interfering. That said, of course, they're interested in taking care of their investment, and they will want to understand what's going on so that they can either respond potentially with more capital for acquisitions, or indeed just to hold management accountable for performance against plan. Now, plans can be exceeded, plans can be undershot for all sorts of reasons, and private equity investors, again, are generally sensible people in that if they understand what's going on, that's the most important thing. So I think the key is that post-deal that PE are generally supportive investors that take a close interest, but they're certainly not interested in getting involved in the management in any way at all. In terms of positioning for private equity, I mean, private equity can be quite a flexible solution. It can be both used as a way, as a buyer, an outright buyer for a business, if there's a clear case for a sale to a management team that's already in place. It can be used as a partial sale, whereas a trade buyer will always want to acquire 100% and then structure something with an earn-out. Private equity could be used maybe to acquire a stake, but not all of a business, and create the opportunity for owners both to sort of take some cash off the table now and de-risk, but also continue to share and drive the upside and potentially get 2 bites of a cherry. Something that's quite interesting, I suppose, is that with an earn-out, you either earn it or lose it. I guess with a private equity investment, the short-term financial performance is less important than what the future value of the business will be in 3, 4, 5 years' time. So from that perspective, private equity can also be interesting. I think the third area, obviously, for PE is it can be a source of growth capital, potentially for acquisitions and expansion. So positioning with private equity does need some care. I mean, as we heard earlier, that most of them are generalists, and therefore helping them really understand what is special about a consulting business and why that consulting business is going to be sustainable, given ultimately it is a people business and people can leave. So care around why a business is perhaps less people dependent than a cursory review might suggest is important. The management team, who private equity are actually backing, is of fundamental importance. That ultimately is key. And a business plan that demonstrates how growth should be sustainable and can be continued is obviously vital to show how equity value will increase over time. I think the fourth area, and this is one that's often overlooked, is that ultimately the private equity investor will want to exit, will want to be able to realize that investment in cash at some time in the future. Taking the time to be able to show and demonstrate to private equity how that exit will happen in 3, 4, 5 years' time, who the buyers are, what the trends are with those buyers, convergence, the importance of synergy and why the management team and the business is aware of that, all go to help create confidence that this will be a realizable investment in the future. So the positioning is around business plan, management team, and the ability to exit in the future. Those are the key components, I think, of appealing to private equity.
Well, Alex and Ramon, it's Alan here again. Thank you very much, both of you, for both your presentation and your answers to our questions. Sadly, we've run out of time. If there are any questions that you've got, please do send them in, and Equitech will get back to you with their answers. And if you want to discuss any aspect of the webinar or your own firm, please don't hesitate to contact them. Alex White is available, contactable on alex.white@equitech.com, and I'm sure we'll be delighted to hear from anybody who's been on the webinar. And I would encourage you, they mentioned this, but I would encourage you to join the Equitech Edge Club. It's a great source of information and research and real valuable asset for the consulting industry. Do go onto the Equitech website and register to receive that. So that all that remains for me to say is thank you to all of you for participating in the webinar, and a particular thanks to Alex and Ramon for joining us today, for their excellent presentation, and for the real insight that they produced for us through their survey. All the best to everybody, and thank you very much.